We're looking at China today, much like we were looking at Japan in 1989. As it turns out, we were about to experience a bit of a bust. And I wouldn't be surprised if the same thing happened here because of China.
China's economy is about to experience the biggest crash in history that will take decades to recover from. China's impending crash will be similar to Japan's devastating 80% market crash in the 1990s. Even 3 decades after the Japanese market crash, Japan's stock market has still not recovered from its highs. Japan's market crash culminated from specific events that caused the country's eventual fate. Just like Japan, several signals are showing that China's economy already crashed, but you just don't know it yet. This video will go in depth on why Cathie Wood believes China has filled up a major bubble and is about to undergo the largest crash in history. China's housing market has inflated significantly over the past decade, which is demonstrated by the consistent increases in Chinese housing prices. Unbeknownst to the majority of investors, the Chinese real estate bubble is about to pop in a serious manner. Before we get into the indicators, we have to address the striking similarities between China in 2021 and Japan in the 1990s. Over the past 2 decades, Chinese real estate developers have leveraged up in order to quickly expand their real estate portfolios. This sounds great on the surface, but it also means that the market has extreme fragility going forward. We've seen this happen with Evergrande, the most indebted real estate developer in the world. This frightening pattern is evident with other Chinese real estate companies as well. At least 4 other major Chinese developers have recently defaulted or asked investors to wait longer to repay their debt. This includes Fantasia Holdings, Modern Land, China Properties, and Xinyuan Real Estate, all of which are failing to pay hundreds of millions of dollars worth of debt. According to economists at Nomura Holdings, real estate developers took out over $5 trillion worth of debt during the Chinese bull run. When so much leverage is in the market, a market crash is almost inevitable, just like Japan in the 1990s. From 1990 to 2003, Japan's Nikkei Index crashed over 80% from its record highs, and even today, the index has not returned to those levels. This disaster is known as the lost decades, because investors in the Nikkei Index at the peak would still be down roughly 25% after over 30 years. Imagine investing in the S&P 500 and still being down 25% after 30 years. China suffering a collapse that destructive would not just affect Chinese citizens, but also the entire global economy.
We're looking at China today, much like we were looking at Japan in 1989. So in 1989, Japan was at the peak of its real estate boom. The Nikkei had hit 40,000 or was close to it. And the world largely thought, wow, there's no stopping Japan. Japan's going to become the largest economy in the world. And of course, that didn't happen. Japan's boom, real estate boom, was destined to unravel. I'm sure many of you have heard the story where the emperor's palace in Tokyo, that piece of land, was worth more than the real estate in the entire state of California, which also had seen nice real estate inflation. So that was destined to fail. And the Nikkei has yet to get back to that 40,000 level. So that's 30 years later, 2 years later.
According to Moody's, which is a credit analyzer, approximately 70 to 80% of China's household wealth is tied up in real estate. If the real estate market crashes 80% like Japan's market did, then the entire global economy would freeze. Every country depends on China for its manufacturing of almost every single good. A sudden slowdown from the Chinese economy, instigated by a real estate crash, would slow down consumption worldwide. This crash may happen as soon as January 2022, which is only a few months away. Goldman Sachs found out that over $6 billion of real estate development debt is due in January of 2022. That is a substantial increase from the current developer debt payments of less than $2 billion in November. Several Chinese real estate development companies are already failing to repay their debt, but imagine what will happen in the coming months when repayments explode. Another downward catalyst for China is the Chinese Communist Party's attempt to crack down on speculative and illegal real estate deals. The CCP is currently initiating strict regulations on real estate companies to provide more equality to its citizens. This sounds logical on the surface, but Cathie Wood believes that such actions are equivalent to playing with fire. When people play with fire, they eventually get burnt.
China's real estate has been very, very important in terms of propelling its economy forward. It was part of the infrastructure build out. They needed it, but it also became the most important part of consumer savings. By some estimates, 75% of all consumer savings in China is in real estate. Now, China's cracking down on real estate, and home prices are falling. And there's a bit of social unrest about it, but China's trying to tackle the have and have not problem, the social unrest. Certain people have these magnificent homes or are in magnificent buildings, and others can hardly afford a tent. This has become unacceptable and untenable in China, according to its leaders. And so it's driving these prices down. And those who have the savings in the first place are losing the money, but this is a risk China's willing to take. I think China's playing with fire on this particular topic, especially because they are also targeting the financial regulators who oversaw financial institutions who were lending to the real estate sector. And the national government is also investigating certain financial firms. So, this is the lifeblood of their economy.
I've talked about in previous videos how the commodity market is extremely dependent on China. China's demand for commodities represents 15% of the entire global GDP, and countless commodities almost solely depend on China alone. Among these commodities are iron and copper, which are currently crashing at incredibly fast rates right now.
The iron ore price since May, June has dropped more than 50%. And it tried to rally in the last month or so, and that failed. It has relapsed. And so we'll see if it breaks down to new lows. But that is very telling. We're seeing copper prices down 10 to 15%. Now, still very high by historical standards, but down 10 to 15% nonetheless.
Declining commodity prices is usually beneficial for almost all companies worldwide. Cheaper materials typically lead companies to have a lower cost of goods sold, which equates to higher profit margins. However, this is not the case right now. Declining commodity prices are indicating that China's economy is slowing down. And if China's economy slows down dramatically, then the global economy will as well. Cathie is surprised that nobody is looking at the correlation between China and commodities. The fact that commodities are crashing is indicating that China's economy is already slowing down. Most people just don't know it yet. Cathie believes that in hindsight, investors will think that a further commodity crash was inevitable.
What surprises me is that the headlines are not blaring this topic, China versus commodities. And it's because I think we're not paying attention to it because there are so many other dramatic things going on out there on the side of inflation. And that has captured much more headline space than what's going on in China. But at some point in the future, I wouldn't be surprised to say investors, of course, how could we not have expected these commodities to unwind given what's going on in China?
China's economy is in huge trouble, but that also means that the United States is as well, but not to the same degree. The Federal Reserve has warned that China's real estate crash could affect the US in a very serious manner. The Fed recently released their semi-annual financial stability report, which is typically released 2 times every year. And one concern stood out within the report, which was the Fed's overwhelming concerns about China's real estate bubble popping. The report stated that stresses in China's real estate sector could strain the Chinese financial system, with possible spillovers to the United States. The Fed further explained how in China, business and local government debt remain large. The financial sector's leverage is high, especially at small and medium-sized banks, and real estate valuations are stretched. The Federal Reserve proceeded to talk about exactly what Cathie Wood was mentioning earlier in this video. The ongoing regulatory focus on leveraged institutions has the potential to stress some highly indebted corporations, especially in the real estate sector, as exemplified by the recent concerns around China Evergrande Group. In Cathie's own words, the CCP is playing with fire. The regulation of real estate development companies may instigate the largest real estate crash in history. With $5 trillion of new debt, the Chinese property market is on a knife's edge, and increased regulation might just be the tipping point. The more important statement by the Fed was the potential impact of China's real estate crash on the United States. The Fed stated that, given the size of China's economy and financial system, as well as its extensive trade linkages with the rest of the world, financial stresses in China could strain global financial markets through a deterioration of risk sentiment, pose risks to global economic growth, and affect the United States. Among the Fed's most important portions within the report is their list of potential shocks to the US economy going forward. This list is created by 26 market experts and is accumulated to create a percentage-based statistic. As detailed by this graph, almost 50% of market experts see China regulatory and property risks as a potential danger in the future. Below that is also US-China tensions, which roughly 33% of market experts believe is a concern. And as if it couldn't get worse, approximately 15% of market experts view China's potential slowdown as a serious risk to the US. The Federal Reserve clearly believes that China's impending collapse will be devastating, even for the US economy. Cathie Wood believes that Europe will be hit harder than the US, although the US will suffer as well.
China going to come and surprise us with extreme weakness, which would hurt Europe that more than it would hurt the United States. Europe is a larger trading partner with China, but it would hurt the United States as well.
Investors can prepare for a potential Chinese crash by reducing their exposure to China, which includes American businesses that rely on China as well. If we take a look at ARK Invest's top combined holdings, most of their businesses do not rely on China. Tesla seems to be the only company on the list that has an enormous amount of exposure to China. And even for Tesla, it is not a major concern, because Tesla is supply constrained. Elon does not have to worry about the demand for Tesla vehicles potentially crashing, because the demand is already too high. So there you have it, Cathie Wood's prediction that the Chinese economy is about to slow down dramatically. If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.